Morning, everyone. Welcome to Phillip Securities Research Morning Call for 21st February. Today on the agenda for stock counter updates, we have results for DBS Group, Koda, Manulife US REIT, Singtel, Thaibev, Netlink Trust, UG Healthcare, and for Phillip on the ground, we have Grand Venture Tech, Karin Tech, and also Genting Singapore. And for the macro and sector outlook, we have a summary of the Singapore Strategy Budget 2022 and also the usual Singapore Weekly. So without further ado, let me first start off with Koda's first half 22 results titled Recovering from Factory Shutdown, as their results this half year were impacted by the lockdowns, but they have since resumed at 100% capacity. So a quick recap, Koda is a furniture manufacturer under which they mainly export to the US and also Canada. And other than the manufacturing segment, they also have a retail and distribution arm. So firstly, on the results, if you refer to the table on the left, first half 22 revenue and PATMI were at 46 and 43% of our FY22 forecasts respectively. So the revenue fell 14% year on year. And for the first positive, the retail and distribution revenue increased 14% due to higher demand from continued work from home arrangements. This is mainly referring to their commune store in Singapore at Millennia Walk. On to the negatives, manufacturing sales declined 21% year on year, which is the main reason why the revenue decreased. So operations in Vietnam and Malaysia were suspended for approximately 3 months and 2 months respectively. And for the next negative point, gross profit margins declined to 30% as they continued to incur the fixed operating expenses during the temporary closure of their facilities and also higher raw material costs. On to the outlook for the manufacturing segment, the order book still remains very strong and operations at Malaysia and Vietnam have resumed at full capacity since September and December 2021 respectively. With regards to the fire incident, which happened at one of the 11 factory buildings in Vietnam, it did not result in significant operational disruptions, as the disrupted supply chain has since been managed by rearranging and rescheduling production of certain orders. For the retail and distribution segment, the commune store in Singapore is still doing well. On the China side, they are on track to having 100 stores by the end of the year. So we maintain our buy recommendation with an unchanged target price of $1.10, with FY22 revenue and PATMI estimates unchanged. Catalysts are expected from higher export orders in second half of FY22, with the backlog of orders from first half 22, higher production capacity, and the new sofa manufacturing line, which would be an additional revenue contributor, but would take some time to ramp up. And also lastly, the additional commune stores in China. So that's all for Koda. I'll now be moving on to Phillip on the ground for Grand Venture Technology's FY21 results, or second half 21, which we attended the briefing for. Just a note, we do not have coverage on the counter. So GVT is a components manufacturer with 3 main segments, firstly being semiconductors that make up about 70% of the total revenue. So they manufacture the components that are used by their suppliers to manufacture semiconductors. And next would be life sciences, under which they manufacture components used for laboratories testing and also pharmaceutical applications. The last segment would be electronics, medical, and others, under which they manufacture the parts and also assembly of other equipment and also surgical microscopes. So moving on to the results, on a full year basis, FY21 revenue was up 89%, and PATMI was more than thrice that of that achieved in FY20 and increased to 17.4 million. If we look at the second half 21 results, referring to the table on the top right, so revenue increased 81% and PATMI increased to $9 million. And you can see that the main contributor to the increase in revenue would be the semicon segment, although other segments also saw significant growth. So the higher revenue from semicon is driven by, as expected, more demand with digitalization, EVs, Internet of Things, etc. For the life sciences segment, it benefited from the industry tailwinds with the rise in drug discovery, vaccine production, and also testing activities, which spurred demand for life sciences equipment. And for the third segment, it was driven by increased production of components for medical equipment and also electronic manufacturing products. In terms of supply chain disruptions, GVT shared that basically after dealing it with more than a year now, although lead times still remain very long, there is also more visibility on the supplier's delivery, so that allows them to better plan ahead also. For the new acquisitions, they have proposed 2 acquisitions, firstly being J-Dragon Tech, which is based in Suzhou. If you refer to the chart on the bottom right, with this acquisition, GVT would be venturing into components supply for the aerospace industry, other than the medical and semicon industries, which they are already present in. The second acquisition, which is Formac, is a precision sheet metal manufacturer based in Johor in Malaysia. And both acquisitions are expected to be completed by the first quarter, which is next month. Lastly, on capacity expansion, so they acquired 2 production facilities in Penang, in Malaysia, and also Suzhou expanded capacity for the sheet metal fabrication. And with that, they have a total of 540,000 square feet of factory floor area. And with the acquisitions of J-Dragon Tech and Formac, other than bringing in new customers, and the capacity from there would also directly expand. So that's all for GVT. I will now be passing the time on to Glenn for DBS Group.
Thanks, Vivian. So for DBS Group, our title is Lower Provisions Drove Earnings. So next slide, please. So our FY21 earnings of 6.8 billion met our estimates as higher fee income and strong loans growth offset lower NIMs. The fourth quarter 21 dividends per share rose 9% to 36 cents. I'll move on to the positives. So for the positives, the first one, the fee income grew 9% year on year. So this fee income growth year on year was broad-based and was led by wealth management and transaction services. However, quarter on quarter, it fell 8%. This is despite higher card and investment activities, which were offset by seasonally lower wealth management fee income. The full year fee income grew by 15% year on year to a record 3.52 billion as economic and market conditions improve. So the second positive is that the asset quality is stable with full year 21 total allowances at 52 million. So the fourth quarter 21 total allowances, however, were significantly lower year on year, but higher quarter on quarter due to a lower write-back in GPs. The SPs fell 82% year on year to 867 million or 6 basis points, but remain relatively unchanged quarter on quarter. As mentioned earlier, the full year allowances fell 98% year on year to 52 million due to repayments of weaker exposure, credit upgrades, and transfers to non-performing assets, resulting in general allowance write-backs during the year. Full year credit cost of 12 basis points is below pre-pandemic levels. Management has guided for similar allowances for full year 2022. The third positive is that loan growth was up 9% year on year in the fourth quarter. Loan growth was led by non-trade corporate loans, with growth led by drawdowns in Singapore and Hong Kong. The housing and wealth management loan growth was sustained at the previous quarter's levels. Full year loan growth of 9% was the highest in 7 years, as growth was recorded across the region and a range of industries. Management has guided for full year 22 loan growth of mid to single digit or better. As for the negatives, the net interest income and NIMs remain relatively unchanged. So NIM remained flat quarter on quarter, but declined 6 basis points year on year to 1.43%. And this is a result of lower market interest rates as customer deposits grew 3% quarter on quarter to 502 billion. Net interest income grew 2% quarter on quarter to 2.1 billion as higher loan and deposit volumes were moderated by stagnant NIMs. Management has guided for similar full year 22 NIMs of about 1.45 to 1.5%. For the outlook, the business momentum remains strong, and despite economic uncertainties from Singapore's return from COVID, loans and transaction pipelines are expected to be strong. The GP reserves are also sufficient, and with its capital position and liquidity well above regulatory requirements, the CET1 ratio of 14.4% in the fourth quarter versus 13.9% in the last year, as well as high allowance reserves, we believe that DBS has sufficient provisions to ride out current economic uncertainties. Also, if we were to include the recent acquisition of Citigroup's Taiwan consumer banking business and MAS's operational risk penalty, DBS's CET1 ratio of 13.3% is still at the upper end of their target operating range. As mentioned earlier, their fourth quarter dividend per share is up 9% to 36 cents, and this is above their pre-pandemic levels. So there's also upside from higher rates, and DBS has mentioned that a 1 basis points rise in interest rates could raise the net interest income by about 18 to 20 million, or this is a net interest income sensitivity of 2% for every 10 basis points. So if we were to assume 2 rate hikes of 50 basis points this year, our full year 22 net interest income can climb 2 billion or 21%, resulting in an increase in our PATMI by 26%. So lastly, this is a benign provisioning cycle, and DBS has guided credit costs of 12 basis points, which is below the pre-pandemic levels of FY18's credit cost of 19 basis points and FY19's credit cost of 20 basis points. And this lower credit cost is due to lower SPs and an improving environment. Thus, we maintain and accumulate with a higher target price of $41.60 as we raise FY22 earnings by 2%, mainly from raising net interest income estimates. So we now assume 1.79 times price to book, up from 1.56 as we raise our ROE estimates to 13%. So that's all I have for DBS. I'll now hand it over to Natalie.
Thank you, Glenn. Good morning, everyone. I'll be talking about Manulife's full year 2021 results, and the title of the report is Leasing Recovery Overpowered by Occupancy Loss. Next slide, please. Starting off with the table on the top left-hand side, we see that gross revenue has fallen by 4.7%, and also net property income has fallen by 5.4%, and the greater decline in net property income was due to higher rental abatement or rental waivers of 1.4% of GRI. And this compares to the 0.5% GRI rental waivers in the previous year, which is FY20. There was also a slight reversal in the expected credit loss of about $1.7 million US. Overall, DPU fell by 5.5%, and also this is another 5% fall in DPU. So this is the second year of negative DPU growth, basically. On the positive side, you see that leasing momentum has doubled year on year, with net effective rents improving by 3.4%. In total, 654,000 square feet, or roughly 12% of NLA, was signed in FY21, and this is 2.3 times the NLA executed in FY20. Reversions came in at negative 0.8%, and this compares to FY20's positive 0.1%. Reversions were weighed down by one asset in particular called Michelson, and Michelson, excluding Michelson, the reversions for the portfolio would have been 3.3%. And this compares to FY20's reversions of 4.7%, excluding Michelson. So the reason why Michelson is actually producing negative rental reversions is because the tenants have been in the building for a long time, and these long leases, they do have annual step-ups of between 2 to 3%. So basically the leases have been escalating annually for a long period of time, resulting in an above market expiring rent. So when the leases are renewed, they are actually renewed and marked to market at a lower rate. That then leading to negative rental reversions. Okay. Overall, the length of leases signed in FY21 was about 4 years, slightly shorter than last year, which was 6.4 years. I think the key takeaway here would be the improving net effective rents. So net effective rents would be your rental minus the tenant incentives that are offered to the tenant, as well as the rent-free period. So it is a more reflective number of how the leasing momentum or leasing sentiment is. And generally, it has been improving, about 3.4% improvement year on year. Another positive would be Manulife managed to acquire 3 properties in FY21. So these 3 properties, 2 of them are located in Phoenix, 1 of them located in Portland, and they will increase the Manulife's exposure to new economy tenants. So these new economy tenants are tech tenants as well as life sciences tenants. It will increase from 9.5% to 12.8% of GRI. Yeah. So Manulife is kind of lagging behind its peers with respect to the percentage of tenants in new economy segments. That its peers like Prime as well as Keppel Pacific Oak, they have about almost 30% of the tenants actually in new economy sectors, and that also kind of explains why their Manulife's peers have been enjoying sort of better reversions. Okay. So Manulife does have a target of about 20% of GRI for these new economy tenants. In terms of outlook, so about 8.1% of GRI is up for renewal this financial year, FY22, and passing rents are about 2.1% below the market. So that means that that there's like strong likelihood for positive rental reversions. Apart from that, the US market appears to be at an inflection point. So the return to office should help to increase car park income as well as leasing momentum. So as more tenants actually come back to the office, they are then able to assess whether they need whether how much space they need and for how long they want to extend their leases. Yeah. So most of these discussions, they have been sort of stalled or put on hold, pending further clarity on their space needs. Overall, we upgrade our recommendation from accumulate to buy. DDM target price raised slightly from 84 US cents to 86 US cents. Below our FY22 to 2024 DPU forecast by about 2.1 to 6.3%. This is to factor in the gradual recovery in occupancy from Manulife's current lower than forecasted occupancy. So all in actually, their results for FY21 actually missed our forecast, and they only formed 93% of our DPU forecast due to this lower than forecasted occupancy. Okay. And our target price is raised ever so slightly because we roll forward our DDM forecast to the next financial year. Okay. At this current price, Manulife is trading at an 8.6% DPU yield. And that's all for me. I'll now pass the time on to Tim.
Yeah, thanks, Nat. Just a Phillip on the ground for Karin Tech. Next slide. So Karin Tech is a component distributor, IT infrastructure service provider, and lastly, consumer electronic product distribution and retailer. So the biggest proportion of revenue comes from IT infrastructure. But for their consumer electronic products, the types that they sell includes what you see on the right, which is headphones, smartwatches, speakers, and all this consumer electronics. So this segment for the first half of 22 did very well. Revenue was up 88% year on year. This was due to some release of new products, and a lot of it came from because of the Hong Kong government's consumption voucher scheme. So most of their businesses is in Hong Kong, and this voucher scheme provided to consumers was to boost this sector. And so Karin Tech, this segment of theirs benefited greatly from this. But the voucher is only up to January this year, so it has already ended. And the outlook for this, and the outlook is a bit blurred also due to the Omicron impact, which resulted in lockdowns. So for their consumer electronic products, this segment, the growth may moderate this year. For their IT infrastructure segment, which is the largest portion of revenue, it was up 6% year on year. And this was due to ongoing momentum in enterprise hybrid cloud. So demand for on-site data centers and also using public cloud provider data centers. This including network security, data management, all this digitalization of enterprises. And there's still momentum here in Hong Kong. We see that it's still in Hong Kong also, in addition to the US also. And this was largely management gave some insight on this, which is in the past companies were avoiding this digitalization, but as more and more companies adopt these technologies, many of them are looking into these cloud solutions now in order to avoid being left behind. So Karin Technology is a distributor for all these big brands in the cloud space, including IBM, Dell, Huawei, Alibaba, and AWS. So they are a big beneficiary of this trend into the cloud. In addition to the cloud, Karin Tech is also looking into Internet of Things, so such as healthcare gadgets, building sensors, all this connected into the internet. And this is also a new trend in the smart city for Hong Kong. But this seems to be a new thing started in 2019. For the last segment, which is quite interesting for the component segment, so they are a component distributor. With regards to supply constraints, it's still lingering. So currently now the lead times can last from 9 months up to 2 years. Pre-pandemic, it was 3 to 4 months only. And when COVID began, it was around 6 months. So now it's 9 months, it's still lingering. The demand is extremely strong, especially from the car manufacturers and the IT sector. But what's interesting for Karin Tech, as compared to Grand Venture, which Vivian touched on just now, is that Karin Tech seems to have enough supplies for their customers, but the customers are still delaying orders due to lack of components that the customers are lacking themselves. So that means that Karin Tech is unable to get their orders to the customers because the customers are sort of rejecting it until they get other components satisfied as well. So the shift in this industry is going on as vendors. So vendors are now shifting down from the high-end market to the mid market because there's more supply there. And so more customers, so the customers can actually accept the orders. So there's an interesting trend happening with regards to the component sector in Hong Kong. So that's all for Karin Tech. Pass my time over to Paul.
Thanks, Timothy. So I have a couple of results to brief everyone. So the first one will be Singtel. They provided a third quarter 22 update. There was no analyst briefing and the financials are limited. So let me just share whatever you can. So from the title, the key point from the results was that they continue to see mobile ARPU rise in Singapore, Australia, and India. Next slide. If you look at the results, the first point, the results was within expectations. The positives for us was the improving mobile ARPU, which is a positive thing because if you recall, mobile ARPU, or which is selling price, hardly moves. It's probably on the downtrend for the last 3 to 5 years at least. But what has happened is that we're beginning to see recovery in Singapore and also in Australia, and more notably in India. They're coming back because of the more benign competition, especially in India. There's a bit more roaming revenue, and you're also benefiting from modestly from some of the 5G rollout. So as a result, if you look at the table on the left, you can see Singapore EBITDA improving, Australia improving, and also Bati. You can see the big jump from 28 million loss to a 45 million profit for the quarter. The negative was just the enterprise business is lackluster. Singtel has been trying to build up their enterprise business, although there are growth engines of cloud, cybersecurity, but they mentioned that they've been bogged down by legacy telco services. They didn't really mention what were these, but we can guess it's probably also they're impacted by roaming for their corporate customers or even IDD from corporate customers. And the other weakness was just lack of IT projects. So in terms of the outlook, we are still positive on Singtel. but it's more of a macro tailwind that they will benefit. Because the emerging markets, improvement in emerging markets which they operate, namely Thailand, Indonesia, Philippines, India. So for us, demand for mobile services in these countries is more discretionary, because in these countries, most of the plans are prepaid. So if the income levels are better, they will dial more, use more data, and spend more, because it's on a per pay usage kind of, in a way you could say. Not unlike here, all of us are on fixed plans. That was for the emerging market exposures. And then for Australia and Singapore, we think they will rebound because of improvement in roaming as borders reopen. And also you get this modest uplift or incremental uplift in prices as more customers move into 5G. So no change in our recommendation and target price. Next slide. So for UG, glove maker, they reported their second quarter results. So for us, we're beginning to see some price stability. It's not a rebound, but at least it's dropping less, modestly. And also beginning to see some value creeping up in the share price. Next slide. So in the first point, the results. So results was within expectations. Although the earnings was brutal, it was down like 67%, but it's more or less within what we kind of expected. What has happened is the glove selling prices dropped more than 50%. And also there was some disruption in production from July to September, but that's no more of a first quarter phenomenon. In terms of the positives, the balance sheet continues to be strong. If you look at the table on the left, the net cash, it doubled from 32 million to 73 million. Then in terms of the negative, has happened is that they are going to build a new plant, a 1.2 billion glove plant. But because of pandemic and so forth, so the timeline has been delayed from March to May. Because no construction work in June to August was actually, there was also lockdown and short of workers and so forth. In terms of the outlook, what is happening on the ground is that the glove prices are still declining around 10% for the upcoming quarter. But what has happened is also because of the Chinese manufacturers. So because the Chinese manufacturers are disrupting the market with very low prices, then the Malaysian peers, namely like Hata, Lega, Topgolf, they have to either match or just charge a small premium. If not, these customers, mainly the US distributors, will just buy from the Chinese. But no, UG has higher visibility of this because they actually buy gloves from the Chinese because they are also a distributor. And also, there's ample capacity in China. There's still ample capacity, and one way to kind of demystify, to compute whether there's ample, there's no precise number, but what they can see is from the lead times. So their lead times are quite short. So that kind of implies that they probably have a lot of capacity or even inventory on hand to meet the delivery times. So in terms of the outlook, we think UG can fare better, namely despite the lower prices, namely because number one, they actually can benefit from the lower prices. Like the Chinese, they can outsource, so they actually can take orders from third-party factories, which is the Chinese. Then number two, UG can also so UG benefits because who they sell to is actually the end customer, like doctors or hospitals. So those prices are holding up better. So they can buy the cheaper factory gloves and then just still sell it there. And also, they're also benefiting because you are beginning to see demand from unusual sectors. Even farming now is using more gloves, beauty, and also the emerging markets, especially China, which is weird because they sell latex. So those competitors that you see is nitrile, which is synthetic rubber. But the demand in China itself is mainly latex, which is natural rubber, because actually it feels more comfortable if you ever tried it. So they are upgrading the quality because of health awareness. Yeah. So as a result, we are upgrading to accumulate. And also because we see it's trading about 5 times PE and they are trading below book, and also 40% of the market cap is in net cash. Although we don't realize that there won't be much momentum, and valuation per se is not going to make the share price move, but we're just beginning to see some value now in the share price. So until prices start to stabilize, or at least selling prices start to creep back up, then I think then only you probably can see momentum in the share price. Next slide. So for Thaibev, they released their first quarter, no, December 22 update, December 21, but it's the first quarter update. Again, no briefing, no financials. So in terms of our title, what we saw was the spirits, which is their brown whiskey, or no, you can call it. Not whiskey, sorry, their brown liquor or spirits. So what has happened is that the volume has increased, but the margins were still poor. Why we always focus on spirits is because spirits account for 85% of Thai beverage PATMI. Beer is only maybe 5-10%. So if you want to pay attention, you can. But usually we just focus on the spirits business because most of the earnings, or almost all of the earnings, come from spirits. Next slide. So in terms of the results, it met expectations. It's a bit higher than usually we just try to trend it. So it's a bit higher because of the December festive period. So that's why it's a bit higher than forecast. In terms of the positives, there was in the last quarter, if you can recall, the volumes were actually very bad. I think it's down almost 18%, but this quarter it actually bounced back up. So if you look at the table on the left, in red, you can see that the volumes rebounded 8%. But we were actually quite surprised. Revenue didn't move as much. And what we think, although they didn't mention, what we think is probably the Myanmar currency put them down because they also sell spirits in Myanmar. And also we think that they actually did raise price in October, but there could be some front loading. So that's why the volumes were up, but you didn't see the revenue up. So we think, okay, sorry, let's move on, sorry for that. So in terms of the margins was the negative part. So you can see that even though revenue was up almost 4% for spirits, but the EBITDA came down. So because there was margin pressure from raw materials, and we think also they have to normalize some of the advertising and marketing because the last financial year, they probably cut like 100 million Sing in advertising and marketing. And you cannot continuously do this, you will hurt the brand. So they probably kind of resurrected that. So in terms of the outlook, we think there'll be a recovery year for FY22. In part because FY21 was just so bad. So there will be a rebound because as the border measures are removed, entertainment outlets reopen, and then borders reopen. And of course, the economic conditions will also improve in Thailand and Vietnam. And another driver to the results for this year will be price increases. So the spirits actually increased their price in October, and the beer in Vietnam also increased prices also last quarter, but you haven't seen the full impact. So you will only see the full impact, in this calendar year, FY22. So no change in our target price or our recommendation. Next slide. Okay, so I think this is the last one. Okay, so I know we got one more. So this is Netlink Trust, third quarter results. So for us, what we're worried right now is just that the higher interest rates will become a headwind for this stock. So the strength of this stock as a fiber provider is stability, and they give you a stable 5% yield. But the issue right now is it's become more bond-like. It's a bond-like equity. So if you can't grow this, then we just worry that the stock might get punished later on. Next slide. So in terms of the results, it's more or less in line. I mean, Netlink hardly, this is like you're talking about 1-2% growth every year. So there shouldn't be any surprise. It's like stable, 2-3% growth every year because that's the strength of it. In terms of the positives, there was a pickup in connections. But if you look at the number, I mean, the connections, we didn't shade it in yellow, but you look at under the residential, so it's only a 1% pickup, but you're talking about small percentages for this stock. So there was more connections, which is people like residents like us that use fiber. So there was like 7,000 this quarter new connections versus there was the highest in 5 quarters. The other positive was the plunge in interest expense because they managed to renegotiate and hedge some of their interest expense just in time actually last year before the recent run-up. In terms of the negatives, I think this is just minor. I mean, the diversion revenue was just down 48%, but again, you're talking about just a couple 100,000. So it's a big number in percentage, but the actual impact to the revenue is actually quite limited. So in terms of the outlook, the other thing to take note of is probably the more important thing is the regulatory review of the fiber price. So just to refresh everyone's memory, every 5 years, the government will reprice the fiber. That means the fiber that we all of us pay, the government will, because it's a monopoly, so the government will decide how much that all of us have to pay Netlink. The last review was 2017. So the next one will become effective 1st January of next year. So by 4th quarter, the decision has to be made because they have to move the prices by January. We worry that the price might come down. That means the prices that all of us pay will come down because when 2017 to now, no, there's obviously more customers, so they can afford lower prices because the total revenue will still be maintained. So we worry that revenue might dip a little bit if prices come down, but we think that there is additional lever. So this is a bit complicated because for business trusts, not like REITs, right? They can actually pay more dividends if they borrow more or they take on less capex. Because REITs don't compute capex as a distributable dividend. Yeah, sorry, this is a bit complicated, but you can think of business trusts as just pure cash flow accounting. So as a result of that, we're not too worried that dividends can come down. So for our view, we downgraded it because we worry that interest rates, we raise our WACC because we worry that higher interest rates means they will have to refinance at a higher cost. Valuations will get impacted because our DCF will bring it down. And also the appeal of such stocks, bond-like equities, right? Because as interest rates rise, the appeal of this fixed rate kind of fixed dividend kind of stock will reduce. Next slide. Okay, let me just run through this. My last question before we go. This is our Singapore strategy. We just released the report. So the key thing for us was probably that there will be cascading of wages and the tight labor conditions can persist. Yeah, I think that's the key theme. Next slide. So the problem for doing a report on the budget is that it hardly moves any share. In the near term, hardly anything gets impacted. But if I had to narrow one sector that could get impacted in the near term, it's probably going to be defense, like someone like ST Engineering. Why we say that is that if you look at bullet point number 4 under sector snippets, you'll see that total defense expenditure for Singapore actually rose 6%. I think the prior year was 18%. And this is high because pre-pandemic, you're talking about actually it's FY 2017 to 2020, I think. Yeah. So actually, because usually the government only spends maybe 2% growth or 3% growth in defense expenditure. So this year is going to be almost triple that. So that's why we think it's a huge jump for defense expenditure, and it should benefit ST Engineering. So let me just run through some of the key highlights for us. I think it's like a 2.5-hour kind of speech by him, by the minister. So the first bullet point is just to tell you that the budgeted deficit was actually supposed to be down 11 billion, but we actually only 5 billion. So the 6 billion actually came from higher stamp duties because of the property market. So actually that helped balance our budget, the government's budget a bit better. I won't run through the rest. I think most of us know. But the overall arching theme for us for the budget is that it will cost higher wages. Although the lower tier, because of progressive wage model and so forth, although the lower tier, I mean, socially is good that they get higher pay, but we worry that it will cascade outwards. Because once the lower tiers have higher wages, then the tier above also has higher wages, and it could cascade further up, and it will continue cascading. I mean, not until middle management, but I think it will have this effect, and this will hurt mainly the retail, F&B, construction, and also manufacturing. And of course, there will also be higher wages demanded for foreign workers, for foreign labor. Just two last things. Of course, everyone's speculating on the wealth taxes, but I think from the speech, if most of us who have read it, you will know that it's almost impossible. Impossible because it's not easy to implement. Because firstly, the wealth is mobile, and secondly, you're not even sure how to exactly calculate what is wealth. And also, fewer and fewer countries in the OECD are taxing on wealth. So I think very highly unlikely they were going to impose some wealth tax. Maybe just keep on raising the property tax. The other thing to note is just that the corporate tax, they just hinted that Singapore might lose some tax revenue because of the new global tax system. The third one, healthcare, is just to remind everyone that Singapore is getting older and older. Yeah, and they're going to spend a huge amount on healthcare. Yeah, I think can move on. Next slide. Okay, this is our usual weekly. So for the macro, we had some property numbers. It's still really weak, down 60%. But a pinch of salt, because also I think the unsold inventory is also very low. You know, our usual run rate is probably 10,000 units sold. So right now, I think the unsold inventory, sorry, I forgot to double check, but I think it's probably one of the lowest, around probably 15,000, 18,000. So our inventory is also anyway quite low in terms of unsold units. Okay, in terms of the other data points, it remains positive. I think our export numbers remain very robust. And the other thing is just the RMC, ready mix concrete. So this will benefit more like Pan United. So the December 21, you can see there's an 18% jump in demand. So this will benefit Pan United and also Hong Leong Asia. And when we look at the second half volumes, because first half results already out, the volumes will jump about 50%. So second half earnings should also be quite robust. I mean, based on the industry volume numbers. Since I think Pan United has 40% market share. So in terms of the data coming up from the US, there was the Fed minutes, but I think all the Fed officials turning more and more hawkish. I think the value of the minutes is probably not so pertinent. There was a comment by one of the FOMC members that he don't see the need for a 50 basis point hike. Retail sales continue to be very strong in the US. It was up 13% in January. Pre-pandemic, retail sales was probably growing 4 to 5% only. So you can see there's a very robust numbers in the US. In terms of technical views, apart from the Ukraine phenomena, we think that banks can still rally. We think, although the market has priced in 6 rate hikes, we think the inflation numbers will still be very high, and because there'll still be one more inflation read in March, next month in early March, we think inflation numbers will still be high. The reason we say that is that the inflation in the US, the numbers only start to move in March onwards. February was still low. February last year, inflation was still below 2%. So when not all of us measure year on year, so you're going to see another big headline in CPI. So that could still drive the inflation rate trade. But we think that near-term peak could happen when the Fed meeting. I think once the Fed meeting comes out, then they start telling everyone they're going to raise rates, then we just worry the banks might have some profit taking then, because you're already pricing in 6 hikes and maybe move to 7, then you're probably more or less baking in a lot of rate hikes here. Then this trade might kind of fizzle out in the near term. In terms of the events to watch, we will have OCBC results, and there'll be another inflation number coming out in the US on Friday. This is probably the more important one, because this is what the Fed usually targets 2% and is using this barometer, the core PCE. And also we have an elite commercial webinar for those who are interested. Next slide. Okay, this is the usual, that's the COVID cases. The good news is that the blue line is coming down. So COVID cases is dropping very sharply. Next slide. For Singapore, if those who have listened to the ministry task force, they're really opening up very fast. And there's the VTL land with Malaysia, they are reinstating the quotas. They are starting VTLC, and they're also adding more countries for VTL land and then lifting the current 50% cap. The posture now for the authorities is not so much to test you, but just to check your vaccination status. Then the negative news, at least more for Q&M, is that when we look at the need for PCR, there's hardly any compulsory need now. In the past, when you arrive, you actually need a PCR. So right now, even that, they remove it and say you can also do a ART or PCR. So there's virtually hardly any mandatory PCR tests if you are arriving in Singapore. Next slide. Okay, this is just an illustration. You can see the export numbers on the left continues to be, this is kind of the fastest growth in more than a decade. And this is a blended number. The table on the right is just ready mix concrete demand. And you can see that it's almost back to pre-pandemic, which is a good number. I mean, it rebounded so fast, the demand for ready mix. Next slide. Okay, this is my last one. This is just Philip on the ground for Genting Singapore. I know most not able to attend, so let me just share. So for the results, you can see that it was down almost 50%. They actually gave a third quarter update. So most of the analysts was focused on fourth quarter. Why fourth quarter profit was down 70%. I mean, when you attend a Genting Singapore briefing, they don't give slides, they don't really give much details. But anyway, the reason given was that it was softer because a lot of the rich locals probably started traveling outside. Again, this is the answer, so don't ask me why. The other thing of the main talking point was also dividend. So they kind of articulated that they would have a more firmer and better dividend policy. So we think they're going to raise the dividend and make a more firm commitment on how much dividends they're going to pay. Why they're doing that is that they have 3 billion net cash, and they are no longer pursuing Japan or any other overseas casinos. The topic of Macau was discussed, and they see that there's limited visibility of whether is it an auction, is it negotiated, so they probably won't participate. Of course, the RWS 2.4 or 2.0 is still on, and I think you can see they're going to add million land and so forth. There was this talk about social gambling. I think for those who did not see, social gambling is actually now allowed by the act, but again, it's going to be minimal impact for them. There's also this thing of proxy betting. Basically, you are betting on behalf of someone else. So you just want to remind everyone that the casino don't allow such things. So in terms of the outlook, it should improve. Number one, because there's a gradual reopening in their key markets, except China. Also, China's unknown. And they just mentioned that all you need to do is just do ART and then you're free to roam in Singapore. So that's the positive. The second outlook is that with the recent ruling to remove social distancing if you're masking, that will be positive for them. Because right now, every table, you're limited to only 4 people per table. And you need a 1 meter distancing. So if you remove that, then at least you can have more people seated on the table. Not only for casino, but also it's not other rides, it's other rides. Like if you're sitting in, I don't know, a roller coaster and so forth, so you can have more capacity in the theme park. The third is just they mentioned that they will probably firm up a dividend policy, but when you look at the numbers, even though the dividend now is 1%, even you double, triple, you're talking only about 3% yield. So I don't think we remove much. So the share price, we don't cover, but pre-pandemic, this stock about 90%. So maybe there is a rebound back to that level because things will normalize. But just a reminder, casino, this kind of casino is a matured industry. There isn't very little growth. There's very little growth for this type of industry because as you can see, most youngsters don't actually go casino and gamble, from my understanding. At least that's what the management said before. Okay, next slide. Okay, this is just for everyone's reference. These are the results coming out. So most of the results should be up by this week. CDL, Venture, all coming out by Friday. In yellow are those that we cover. Okay, I think we can move on to Q&A. Thanks.
I'll take the first few questions. I think it's about DBS. Okay, so there's 2 questions. I think they're quite related. So the first one is, will the NII and NIMs improve as the Feds raise interest rates? And then the second question is, going forward, what is my take on DBS share price, especially with the impending rate hike? So I think I briefly mentioned it just now, so I'll just reiterate. So for the NII and NIMs, yes, it could improve as the Feds raise their interest rates. So the DBS themselves actually mentioned that a 1 basis points rise in interest rates could raise the NII by about 18 to 20 million. So this represents NII sensitivity of 2% for every 10 basis points. So if you were to assume rate hikes totaling 100 basis points, our NII can climb by 2 billion, or this is 21%, and this will result in an increase in earnings by 26% for the full year 22. So what is my take on the DBS share price? As mentioned earlier, I have put a higher target price of $41.60 as we raise the NII estimates, because this will affect our earnings by 2%, so it's 2% higher. Yeah, that's all I have I think that's all I have. My questions for the banks. I'll hand over to Paul. Thank you.
Yeah, okay, thanks. Let me just try. I dialed in late because I was in the Raffles. I was in the Raffles medical briefing. So appreciate your comments on the latest earnings results, Raffles Medical, and its stock price going forward. We can't share our recommendation, but let me just share some of the highlights for Raffles Medical. Number one, I think so Raffles Medical did well last year because of all the government COVID testing, COVID vaccination. They never gave a number, but IHH gave a number that almost 30% of the revenues come from that, almost, maybe high 20s. So we think that next FY22 will be a weak year for them. Why? Because number one, you're not going to get the government's not going to spend so much on for testing and vaccination. And number two, they kind of mentioned also that medical tourism is facing some challenges. There's more competition now. Firstly, because after 2 years, a lot of these foreign patients, they actually begin to use more of their local medical facilities. And number two, and if not, they will actually a lot of them also go to Malaysia and Thailand, which is more competitively priced. So I just get a sense that they might have lost some medical tourism, and they may not revert back to the pre-pandemic levels. So that would be the second headwind. The third headwind is that China, they have one hospital in Chongqing that opened. They have already opened for more than a year. Then last year they opened Shanghai. So this year in 22 you're going to get Shanghai, and I think Shanghai losses hasn't come in yet. So maybe you get like a 10 million loss from Shanghai. So we think 2022 will be a bit of a headwind for them because of these three reasons. Shanghai losses, medical tourism not going to come back as pre-pandemic levels, and you're going to lose quite a bit of the government COVID-19 revenue. Although they never give any number, but we think it's quite meaningful, maybe 20-30%. Okay, yeah, I think it's a long answer. Yeah, can you help share your view on Hutchison Port? Sorry, we don't really. I don't cover, so I can't really help you on that. Any recommendation on Topgolf and Riverstone? We need to look at UG, but in general, we think until the glove prices start to creep up, all these big ones like Topgolf, I don't think it can rebound significantly. Yeah, maybe Riverstone can, because Riverstone has the gloves for the electronic sector, which they still command very high margins, and they're like the market leader there. Yeah. So for us, our call on UG is more of a value, but value it's not a good timing, not a good timing indicator. So we think even though we have a buy, prices might still move sideways or maybe creep up a little bit until there's visibility that that glove prices rise. The issue right now is the Chinese capacity is as big as Top Glove. So right now you probably have another one or two new Top Glove in the market in terms of capacity. So it will take time to kind of absorb all this excess capacity. These are just my thoughts. What percentage of Thaibev revenue is from Myanmar? Off the top as well, I need to double check, probably 5-10%. Can they reduce exposure? No, I think they just, because this is the largest whiskey operator, and they won't reduce exposure because it's very hard to buy this type of franchise. Yeah, I don't think it's losing money, but it's just that it's not a huge growth driver for them. Yeah, so I think it's still a valuable asset because I think it's like one of the biggest whiskey operator, the Royal brand. Yeah. Yeah, thanks. Hi, Paul, given the weak glove price, would UG's new factory become a drag to the bottom line, taking longer? So in a way, they were probably mildly, I guess, positive for them because they can outsource more. Yeah, the benefit for them is that they actually outsource quite a bit of their gloves. So that means demand is more than they can supply. So right now they will just take more from the Chinese, I guess, as one of the, or even some of the Malaysian glove manufacturers. So I don't think it will impact them that significantly. Yeah. So it will give them more time, and what they mentioned is that they give them more time to find workers for the factory and not rush and try and fill it up, and also spend more time on branding. Yeah, that's what they said. The next one is property. I'll leave it to Natalie. Any update on Genting's bid for Japan IR? Yeah, I think they just mentioned that it's no longer on the work. Yeah, I think like we highlighted earlier, they're no longer looking at a Japan bid or any other bid. So that's why they can be firmer on the dividend policy. Okay, on the budget insights on iFast, not sure, maybe Glenn can take that. Or even insurance. What are your views? Okay, Natalie, I think we can hand it to you. Some of this property.
Hi, okay, so some of the questions on increasing property tax on the rental market and hence residential market, as well as another related question on, can you share your views on property counters, the CDL, in light of the higher property taxes? So these are questions in relation to the budget announcement. So for the budget announcement, I'll just briefly talk about it. Okay, so the property taxes that were raised are for residential as well, for owner-occupied residential as well as non-owner occupied residential, meaning like basically it's houses, but whether or not you're staying in it for your own use or you're renting it out for rental income. So both of these property types will experience this higher higher taxation. However, it's not for all. It's for properties that have an annual value in excess of 300,000. So meaning to say your monthly rental, if you're charging leasing out the property, it's about 2.5 thousand monthly rental. So if your property is actually yielding a higher amount than 2.5 thousand a month, then you actually qualify for this higher taxation bracket ranging from 6 to 32%. Previously, this number was 4 to 16%. Yeah. Okay. So I think in general, don't really expect much of an impact for these from this. Additionally, I think the commentary from some of the property counters would be that usually those people who are buying property, especially if it's your second property onwards, unless they are unlikely to be impacted by these kind of increases, because it's not very significant. The increase is not that significant. Yeah. Yep. Sorry, another question here. What is the impact for the Singapore 2022 budget? What is the impact on REITs as a whole? So actually, there's no impact to the REITs. Nothing that was mentioned there actually affects the REITs. Yeah. Okay. That's all for me. Yep.
Maybe I'll take the one on the iFast. So for iFast, their AUA, just a brief summary on what their results recently. So their AUA continues to grow, and I mean new record levels as usual. It keeps growing. So it's 19 billion as at 31st December. So this means this imputes a growth of about 31.5% year on year. And their unit trust, which is their key investment, also grew about 27.5%. And so their net revenue also grew about 32%. And so their net profit also grew about 44%. So they talk about moving forward, they will need to execute their 4-year plan. So this includes, I think, 4 things. They say they need to get bigger and better and accelerate their Hong Kong business growth, as well as add the digital banking. So they spoke about the digital banking, and they have recently acquired the UK bank, as well as add other capabilities to their fintech ecosystem. And the last one build a truly global business model. So they want to be like the Netflix or Spotify of the finance. So they're still working on that. We don't cover the stock, so there's, I think, apart from that, not much else from me about iFast. So I think any views of Great Eastern insurance business going forward? So Great Eastern, just based on their 9-month, their third quarter 21 results, it went down compared to the second quarter, but year on year, it has shown improvement of about 46%. So we'll just have to, I want to see what the full year results will look like before I comment further. Okay, that's all for me.
Terence, you want to take some if you can. There's Keppel Infra. Not sure if you cover.
Yeah, sure, Paul. Let me. Oh.
So it's in the chat side. Yeah. If you do have questions, it's easier for us if you type in the Q&A so we can compile it better. Yeah, thanks.
Yeah. Okay. Yeah. Paul. So I see. I take the question then. So there's a question. Interest rates will impact on Keppel Infra's price. Yeah. In a way, we think in a way we don't have any coverage on Keppel Infrastructure Trust. So these comments are that's based on our own personal view. So Keppel Infrastructure Trust, they pay a fixed dividend. They've been paying a fixed dividend for the last 6 to 7 years already. So they every year they keep it fixed about 2.7 cents. But in their most latest results announcement, they raised the dividend for the second half 21 slightly. So going forward, the indication we got from them is that the dividend will be raised up. But otherwise, Keppel Infrastructure Trust trades like a bond. Every year they just pay a fixed amount, regardless of their earnings. They pay a fixed amount to shareholders. So if interest rates do rise, then you will expect the price, all things constant, you expect the price of Keppel to be Infrastructure Trust to be impacted because it's the switch, right? Yeah. So let me know if I didn't answer your question. There's another question for SPH. Should investors sell now or wait for the EGM and thereafter accept the cascaded offer? Any insights regarding the delay? Greatly appreciated. So there are two questions. The first is whether investors should sell now. One of the things we note is the share price of SPH is currently below the offer price by Keppel and Cascaden. So what if shareholders choose to sell now, then you'll be realizing a value that is lower than what you have gotten if you wait. Of course, there are considerations whether you want to realize it today or you want to wait. Also note that under the Keppel and Cascaden offer, there's also a likelihood that shareholders could, amongst the possibilities, that they could vote down both offers also, assuming Keppel, of course, is successful in their appeal to the arbitrators, and shareholders get to vote on both Keppel and Cascaden the Cascaden offer. They could vote down. So it depends on your assessment of whether you think the deal would go through. The second question is any insights regarding the delay. The reason for the delay now is because SPH wants to. There are two reasons why SPH think they want to terminate the implementation agreement with Keppel. The first is because when the board is of the view that the Cascaden offer is more superior than Keppel. So they in that regard, shareholders then don't need to consider the Keppel offer when they vote. The second reason why SPH wants to terminate the deal is because in their view, Keppel has not fulfilled some of the conditions. In both of the announcements, both Keppel and SPH did not review what are the terms that they did not meet. So we are not sure what are the terms that Keppel did not meet. But these are the two reasons why SPH wants to terminate the agreement. But for Keppel, they have the view that the shareholders should, the deal that they table to SPH shareholders is a compelling offer. So they, and it's also a little bit different because obviously they offer a little bit of Keppel REIT shares, which obviously is, when taken as a whole, is lower than the cascaded offer, but they feel that they put a compelling offer on the table and they want shareholders to vote. Even if it's to vote it down, they want shareholders to vote on both deals. And because they cannot agree, it is now before the arbitrator. And until the arbitrator make the announcement, then the EGM will not happen. So that's all we know regarding this delay now. Yeah, I think that's all from me. Yeah, I'll pass back the time to the rest of my colleagues. Oh yeah, sorry, I think there's one more question. Maybe on the carbon tax. So the carbon tax, we're still checking on the impact of the carbon tax on Keppel and Sembcorp. We'll get back when we have, or maybe Paul will have something to add also. Yeah, okay, that's all from me. I pass the time to the rest of my colleagues.
Yeah, sorry, the carbon tax, I'm not so, yeah, not really follow up. Yeah, but we'll get back to you. Let me just run a few more. What's your take on Rex International? Actually, after you asked this question, we actually reached out to the company, so we will try to get them to do a LISCO webinar so that everyone can better understand the company. But I don't know. As much as like I said, I know probably as much as everyone else is just an all proxy. But apart from that, we will talk. We have just reached out to them, so we'll try and get them to do a webinar. So hopefully, from that everyone can get a better understanding of the company. When is the result for Yang Zhejiang and Geo? Yang Zhejiang will be coming out before market on the 28th. Geo, we're not sure. They haven't announced, but it's probably going to be at the tail end of, probably on the 28th too. Yeah, because most of them have to report by the 28th. So the carbon tax, yeah, we will try. Any views on Vilma? Sorry, probably don't really have any particular strong views. Once they do the briefing, we will let you know. I think on Tuesday or Wednesday, there's a briefing coming up. For Suntec REIT, maybe Natalie can share better. But for me, for us, we always say that it's a high beta stock on reopening for retail, because they benefit when the convention centers are open, when the atrium is open, and when more people return to office. So if you want a high beta REIT for reopening, I think Suntec is the one, because no other REITs has such a large exposure to conferences, large exposure to atrium. Because atrium is like a pure profit for them. It's like a rental that just goes straight to the bottom line which they cannot do. So if you want something that is going to benefit the most from a reopening in terms of the delta, the difference, there's going to be Suntec. Unless Natalie got anything else to add. Do you cover Singpost? If yes, what is the view? We don't cover, but we've been following it for years. But Singpost has been affected because of the lockdowns. So Singpost has three parts of the business, which is firstly sending us mail, which is is very saturated. The second part of the business, which probably less people know, is international mail and parcel. So if you are sending a parcel from, I'm just giving an example, from China to Europe, it actually comes to Singapore first. Then it goes to Europe. Why not? Because Singapore probably got 100 over flights a day. Pulling a number, I think, I'm not sure what's the example, but probably 100 over flights a day to many countries. So a lot of these parcels get sent. That's probably a reason why Alibaba bought us too, but bought Singpost, is they will come to Singapore before they get sent. But because of all the lockdowns, this value proposition isn't there. So that's why Singpost has been hurt. Then the third part is the freight forwarding. Freight forwarding, they are benefiting. Freight forwarding has done well because they can get a lot of pricing power because there's so little, the allocation is so little, so the forwarders can actually charge higher, I guess. But so Singpost should recover near term because of reopening. But in terms of the longer term play, it will be the ability to deliver mail and parcels more efficiently, which is basically those smart boxes. until they roll that out, they're going to have issues because the infrastructure is not catered for parcels. You send a parcel, the postman has to walk to our they can't fit into our letterbox. Basically, the letterbox is too small. The infrastructure is not there because everyone is no longer receiving mails. We're all receiving all these e-commerce parcels. So they need to take time to revamp. But near term, they can rebound if the borders reopen and the international movement of parcels, like we mentioned from China, or wholesaling. I'm not sure what's the right word, but if that happens, then they will benefit Singapore. Yeah. Okay, sorry, that's a long answer. Any news on the merger? Maybe Terence, you want to help? Yeah.
Yeah, sure, Paul. I'll just read the question. Any news on the merger of Sam Marine and Keppel O&M? Yeah, there are two questions, so I'll take the first one first. Yes, based on the latest update from Keppel, they are finalizing the terms of the agreement. They expect an announcement on the merger by the first quarter of 2022. So that's next month. So we have about a month to go. But otherwise, nothing beyond beyond this. The second question is, would the merger cause another drop in Sam Marine share price? Yeah, so it's difficult to speculate now on how Sam Marine share price will react, because it is dependent on how they're going to absorb Keppel O&M, right? We know that they are going to, as part of the merger agreement, what has been disclosed is there'll be a $500 million payout to Keppel, and then it depends on the manner in which Sam Marine would absorb, in terms of a combination of debt and equity to absorb. So until they announce the terms of the agreement and how they're going to do it, it's difficult to say how it will affect Sam Marine's share price. Yeah. That's all from me. I'll hand the time back to my colleagues.
Okay, thanks. So thanks everyone for all the questions. I think we can come to the conclusion for this meeting. So thanks everyone for attending, and especially thanks everyone for all your questions, and hope to see you again next week. Thank you, everybody. Bye-bye.